Portillo's got a nice boost late last week when it was announced that Jack Hartung, who was actually the longtime CEO of Chipotle, started in that position in Chipotle in 2002. The company didn't even go public until 2006. Prior to that, spent 18 years at McDonald's. He is going to be now on the board of directors at Portillo's. The company actually has a pretty solid board of directors, a lot of restaurant level experience, but this could bring another growth mindset to the company as we're starting to see Portillo's expand its footprint and really try to figure out what those unit economics are going to be outside of the Chicagoland area. So I'm going to go through this announcement, how it could impact Portillo's, and where we should see an impact from somebody like Jack Hartung. If this is going to be a restaurant that goes from a little under 100 restaurants to over 500 over the next 10, 15 years, it's somebody like this who's going to play a pretty big role. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. And if you want some more detail on Portillo's, I'll put a link in the show notes to a deep dive that I did on this stock. This is one that I've been acquiring for quite a while. Hasn't done particularly well, but this is the kind of thing that could turn it around, and it's much more of a value. So let's get into some of those details. Let's start with the market's reaction. This is the move on Friday. Friday was actually a pretty poor day. S&P 500 down about 1.5%, but Portillo stock was up almost 8%. Now, if you back out even just a week, this is a lot of volatility in this stock. And if you go back a year, down about 31%. So hasn't been a very good year for Portillo's, despite the fact that it was a really solid year on the market. But here's that announcement of adding Hartung to the board of directors. Like I said, long history with Chipotle. This goes back to really the early days of Chipotle, 500 to 3,600 stores and a 60x return for shareholders over this period of time. And he's actually going to be able to spend a decent amount of time with Portillo's if he would like to, because he is leaving Chipotle effective March 31st, 2025. He's retiring from Chipotle, is now going to be on 3 boards of directors, The Honest Company, and then there's another company that he's on the board of directors. So this is going to be the only other restaurant companies that he's going to be involved with, at least as we know of right now. So why does he make sense right now for Portillo's, and what is he going to bring? He is on the board of directors. He's not going to be an executive at the company, so he isn't going to be in day-to-day operations. But I think he is going to have a unique perspective on how do you scale a business? What does pricing look like? What should your operations look like? Remember, Chipotle is a very well-run company. Portillo's had a lot of opportunities. I'll get to some of those in just a second, but this is just an overview of the company's products if you're not familiar. A very broad menu, but it's very popular. So high net promoter score. This ties to where there are actually locations, but I'll get to some of that in just a second. And they're actually a pretty good value. If you've been to any of these restaurants, I think some of these numbers are a little bit inflated. A $15 burrito seems expensive, but I do think Portillo's is a pretty good value. And the unit economics are really solid, about $9 million in the average restaurant and almost $2 million in restaurant level adjusted EBITDA, which is a proxy for cash flow coming from restaurants. Chipotle does about $3 million in revenue. So very, very profitable. And now they're starting to grow. This is really the big change. The IPO was in 2021, now adding 10 to 15% increase in the number of restaurants each year. So that's going to help drive the company's growth long term. And you can see that a lot of that growth is really happening in the South, in the Sun Belt. The expansions in 2025 are going to be primarily in Texas and in Florida. And then they're looking at North Carolina, South Carolina, Georgia, Colorado, and then Nevada. But here's one of the things that's really interesting is what their unit volume, average unit volume looks like in each one of these areas. Like I mentioned, the Chicagoland areas where the company started, where it's very, very prolific. You go outside of that Chicagoland area, not very far. I'm in the Minneapolis area. Only $5.6 million in restaurant level revenue. So about half of what they see in the Chicagoland area. Things get a little bit better in the Sun Belt, but I think there's a lot of opportunity to optimize that. They are going to a smaller footprint, so they should have a little bit lower operating costs, a little bit lower build cost. But we're probably not going to see these Chicagoland area numbers all around the country. There are pockets where we've seen a lot of success. I think there was one just outside of Houston where they were doing $17 million in revenue their first year. But that's really what the market's trying to get its head around. What are the unit level economics going to look like long term as the company scales the business? This is a process that Hartung has been through with Chipotle. Remember, these are very similar questions to Chipotle in 2006, 2007, 2008. What do these unit economics look like as you start to scale the business? There may be little things that he could be involved with. So things like improving their pricing, improving their operations, even just slightly. These are the little details that a CFO is involved in, especially at a restaurant company, is where are you going to put locations? How are you going to price in each one of these locations? Are you getting the right kind of return on investment? Are you investing in the right kind of areas? So those impacts could be meaningful as the company starts to scale the business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what are the impacts that we should look for on the business? What does the valuation look like? This is where things start to get compelling, I think, for Portillo's, because right now, some of the numbers look a little bit weak. Look at this chart right here. This shows the columns, the red columns are the number of restaurants. This is on a quarterly basis, so this doesn't include fourth quarter. So you can see that steady growth, about 10% growth since 2020. They're going to pick that up a little bit. The challenge is the restaurant level adjusted EBITDA margin has fallen down a little bit, now 23.5% in the most recent quarter. And the big number that the market is watching is the change in same-store sales. Actually negative the last 3 quarters. That's not the trend that you want to see for a restaurant company, and that's why you've seen the stock really struggle. This should be a company that is able to grow its same-store sales, especially in some of these new markets. But there is volatility. They've talked a lot about that on the conference calls as they start to optimize, they start to figure out where are we actually going to build in Texas or in Arizona. They know what the answer is in a place like Chicago, but they don't necessarily know the answer in some of these new locations. So somebody like Hartung, who has done this before, could potentially help with that. But what's starting to get compelling with Portillo's is the valuation. Now, on a fully diluted basis, and most of the places you're going to look out there are not going to include both the Class A and Class B stock. But the market cap of the company is actually $732 billion. Now, there is some debt on the balance sheet. You can see that in this red column, $279 million worth of debt. So in total, you have an enterprise value of about $1 billion. But the restaurant level adjusted EBITDA in the past 12 months, this is as of the end of the third quarter, $168.6 million. That means that the company itself is just trading for 6 times restaurant level adjusted EBITDA. Now, there's a lot of costs that are going into things like pre-opening expenses. There are general and administrative expenses that are going to be higher than they potentially would be long-term because they're in this expansion phase. But this is good for investors to be in expansion phase and actually getting a pretty good value for the company. I think it's right where you want to be. So if we do start to see some turnaround in their margins, in their same-store sales in 2025, I think we could see the stock get a really nice bounce. And remember that they're growing the number of restaurants 12 to 15% a year. If they're able to continue that and add some same-store sales on top of that, this could be a company that's going to grow 15 to 20% annually for the foreseeable future. A lot of growth runway ahead. You saw in that picture earlier, there's a lot of states where there is zero presence for Portillo's. So we're just starting to reach scale. This is really reminiscent of Chipotle maybe 15, 20 years ago. The company wasn't always a household name. So can Portillo's do this again, get the same kind of Chipotle returns? That's maybe a little bit expecting a little bit too much, but I do think there's a lot of potential for Portillo's. One of the stocks that I'm potentially going to be adding in 2025 as we look for more values in the market. This is the kind of move that I want to see. So very intrigued in buying more in Portillo's. But let me know what you think about Portillo's today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.